Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's September 19th, 2019. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week. We have a star-studded lineup. First, we are joined by macro guru and RealVision founder Raoul Pal. Then it's followed by another Goldman Sachs alum with IVOL ETF manager Nancy Davis of Quadratic Capital Management. For our WTF segment, Steve Laceman does his very best George imitation.
And this week in trading history, we go back to when Soros broke the Bank of England, and then we'll get to the top 5 things to watch next week. So, Lena, jump on here. Who's this show brought to us this week by?
This week, the show is brought to us by Central Waters Brewing Company's Wisconsin Red Ale Beer.
Do you have a description on this thing?
Yeah. So, with its mellow malty flavor and subtle flowery nose, Wisconsin Red gets its name from the Algonquin word for the Wisconsin River, or Red Stone River, featuring a range of caramel malts for mild biscuit sweetness and a warm, rich mahogany color.
All right, well, let's give it a try.
Do you know what I like best? It's not a screw-off cap.
Oh, there you go. You have to use a good old bottle opener.
Yeah, I like
That's right.
You know what? It's actually it's not
really
bad.
Nice. I actually
nice
really
beer.
like it. I'm a fan, which means Patrick's
I'm
going to
save
hit
my
it.
rating for later.
No. It's a nice beer. I do like traditional beers too, you know, Kev.
Oh. You just like all beer, as long as they're cold and somewhat brown. Okay, let me
give it a disclaimer, yeah.
Right. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include dropsy, the vapors, jungle rot, dandy fever, poor man's gout, housemaid's knee, the staggers, and or dum-dum fever. Please consult Dr. Washburn if any of these conditions persist.
All right. Thanks for sharing, Kev. All right. Let's move on. So joining us now is Raoul Pal, founder of the Global Macro Investor and of RealVision. Now, Raoul, you do such a great job articulating your views on RealVision. So any of our listeners that want to know what you're predicting, we suggest you head over there. Now, we'd like to spend the time with you to pick your brain a little bit about your process and try to understand it better. Now, I know from you, you don't shy away from making some pretty bold calls, but at the same time, you have a great track record on those calls. Now, how did this outside-the-box thinking come? Was it natural that you always had it, or is it something that you had to develop?
Interesting. I kind of stumbled into it, and it's the fact that I didn't realize, but I was ideally suited to global macro in the way that it works, because different people have different skill sets. And what I found out is I learned technical analysis very early on, just because that was the first job that I had, was teaching people, was supporting a product called Teletrack in the early 90s, which was a technical analysis product. And I realized that I was a visual person. I saw the world in pictures. And so for me, global macro and that investment framework became much easier because it was about seeing the big picture. So when you see the big pictures, I kind of started to understand, I think it was probably originally whether it was Soros on Soros or one of the early Soros books was about how he would assess the probabilities to various outcomes and reassess the probabilities. And I realized that I could apply that because the charts were giving me something which was a probabilistic outcome of something that I could see in the future. And so it was starting to give me that roadmap of, okay, I understand that there are no certainties. I look out into the future and there's certain probabilities. And if I see that picture that is consistent across a number of different things, then it becomes the ability to make bigger calls. So I kind of stumbled into it. And I started speaking early on in my career in the mid-90s to some of the big hedge fund guys, people like Paul Tudor Jones, stuff like that, Lewis Bacon at More Capital. And I started realizing that how they were thinking was in a similar way. And I stumbled into it and realized, okay, I can do this. Well, at least I think I can. They were obviously better than me, but there we go.
I love the fact that you actually said that, because my follow-up question was actually going to be about technical analysis, because Kevin always calls it the dark arts. See, I love using technical analysis, and he's a little more suspect of it. And listen, and when we talk about macro, there's obviously a lot of macro data that comes out there, but clearly your top-down process then evolves from first seeing the bigger macro and then looking for when is the trend emergent. Is that a good way of describing it?
Yeah, I mean, look, there are different people in macro, and the people who are skeptical of charts tend to be the more bottoms-up macro kind of model-driven in their approach, and it's just a different way of approaching stuff. So they're both equally good, just different ways of doing it, just because different people have different skill sets. And so, yes, I get the big picture from that whole thing, and I found that has been the better thing for me in the way that it works. And I found the charts are the single most useful way of understanding market psychology and what's going on. So you don't need to believe in charts, you don't need to believe in chart patterns, but you have to understand that market psychology is written in that chart. You kind of know what the market has been doing, what people have been doing.
It's Kevin here, Raoul. I think it's Peter Brandt that has a great line. He says something like, the bottom of the ocean is filled with all sorts of captains who also didn't believe in charts.
That's dead right. And I learned this from, it was bizarre, because early in my career, I was a chart guy because I realized that helped me visualize everything. And I never forget when I first got introduced to Paul Tudor Jones, I was like, well, how do you look at this stuff? He goes, well, I couldn't live without a chart. Basically, 80% of his process was the chart. And then once you saw the chart, he would then dig in and do the work. And I found the same was true of Stan Druckenmiller. The same was true of Lewis Bacon. The same was true of George Soros. The same was true of most of them. There were some that didn't use them at all, but really a lot of them did. And they all started with it. I asked Mike Novogratz recently in an interview, I said, what happens if you couldn't look at a chart? He goes, well, I can't trade. Just give up.
Now, what do you think about, you mentioned Stanley Druckenmiller, and he's often kind of used the internals of the stock market to give him signals about the economy. Do you worry that with the changing nature of more and more algorithmic trading and more quants, that some of those what had typically been very reliable indicators are no longer working?
I think about this a lot, as we all do. I'm not as convinced as others are that the market is so screwed up. If I look at the year-on-year rate of change of the S&P 500 and look at it against the ISM, it's still consistent. So the correlation between asset prices and the business cycle seems consistent. Is the business cycle a bit screwy? Well, this is the longest one ever. Are we going to go into recession, or are we going to bounce yet again from this kind of 1% to 0% GDP level? We'll have to wait and see. Is the economy being manipulated? Probably. I don't see the markets as much. However, at a top-down level, you really do see the impact of passive. So the passive fund flows are really what's driving that, value growth divergence, and some of the other things that Stan will pick up in some of the other things. It's, the indicators are less good because I think the passive flows are a big problem. You need to strip some of that out somehow.
Right. And so in terms of the passive, I always kind of say to people, those who complain about all the passive should realize if you are an active investor, this just gives you more opportunity because the stocks that aren't in the index are just cheaper.
Yes. But the question is Mike Green's done a whole lot of work. I mean, an extraordinary amount of work on this. And basically, passive is eating the world. So unless something significantly changes, there is no reason to see a reversal in the, let's say, active versus value. I mean, momentum versus value, because there is nobody there to buy enough value to make a difference. So passive is over 52% of the market now, and it's increasing almost on a quarter by quarter basis. Passive is basically eating the rest of the world, and that's troubling.
But don't you think, though, as the value gets cheaper and cheaper, eventually it's kind of like the best cure for high prices is high prices and the best cure for low prices is low prices?
I do, but the structural flows of capital from the baby boomers exiting means that there's so much active that's being just squeezed out of the market. There's just not enough active people. So can stocks remain cheap for a long time? Yes. So, does value still work? Yes, it probably does. But you're really, really fighting a headwind of every single baby boomer having to sell the stock market. And what they're selling most of the time at first is all active and switching to passive. All the millennial cash flow is all going into passive. So it is a structural shift that I'm not sure how you take advantage of it, because there's no kind of price discovery if there's not enough capital to move the price.
Right, and I guess eventually it solves itself, but the question is, can you take the pain in the meantime? Now,
how long is that? I mean, could it be decades? I mean, look how long Europe's been cheap for.
Yeah,
it's the same argument. Europe and Japan have been the same argument for decades now.
Right. So now you mentioned some different hedge fund managers, some very famous names there. What do you feel like back when you were covering them as a sales trader? They were probably swinging it around pretty good, and it was the days of the swashbuckling hedge funds, and now they feel just more like kind of boring asset collectors as opposed to the good old days when Soros broke the Bank of England. What can you kind of comment about what you see in the hedge fund industry over the last couple of decades?
I mean, I've seen this whole thing from start to finish, and I've written about it a lot, about the death of the hedge fund industry and macro, the industry that I love, and how that is changing. And essentially, to talk you through the history of it, is by the mid-90s, Tiger and Soros and Tudor, Tiger at that point was $20 billion, which was absolutely enormous for a hedge fund then, back in those days. And these were macro, high volatility, high return strategies. And these guys were the gods of the industry, and they'd made more returns than anybody had ever made in history before. So that was the famous days of it all. Then what happened is, I joined the industry. I started working for a hedge fund and running a global macro hedge fund in 2001, 2000 actually. And over that period, while I was running a hedge fund, we started to see changes that the pension funds had already have gaps in their funding. So they were going out the risk curve and buying alternative assets. So that was the rise of the hedge fund bubble. And what happened is the pension funds drove it. The problem is the pension funds said, well, you can have my $250 million, but in exchange, I don't want your 15% volatility, because I've got to model this within my actuarial tables and put this into my outcomes for these pensioners. So I need it to look more like a bond. So can you give me 12% vol? And so we were all like, sure, we'll try and do that. So everyone's risk went down. Then they said, actually, what we want is 8% vol, and everybody's risk went down. At this point, I decided to leave because I saw where this is going. I said, look, everyone was going to monthly reporting of NAV, and they were then reducing volatility to 8%. And I'm like, well, this is not for me. So at that time, and I'd started, and again, not that I'm in the same league of him, but I'd started at the same time as Alan Howard had started his fund. And so Alan took a different approach. So Alan had more capital than us. So he basically said, fine, I'm just going to hire tons of traders, have a diversified portfolio, and I'm going to lower volatility to 6%. And if I lower volatility to 6% and I can generate 10% returns, because Alan happens to be one of the best traders in the world, and interest rates were the great trade, and he's the best interest rate trader probably there ever is. And what happens is Alan gets all the assets in the world. So suddenly $80 billion flow to Alan Howard, and everybody else is out of business who has a higher volatility approach. So that's killed the big swinging, dick hedge fund approach. That's now gone unless you've got a large private pool of capital. At the same time, you've got Paul, Lewis, George, and a whole bunch of these guys who have all basically hit their 50s and 60s in age, and they are now billionaires, the whole lot of them. So their motivation goes from, actually, if I can turn my entire net worth into a bond, I don't need to take the risks, because now I'm a billionaire, I just want to keep it. So their motivation changes. So all of them did the same thing, which was hire a bunch of traders, have the diversified Alan Howard approach, and lower their returns to 6% volatility, and if I can make 8%, 10% returns, I'm great. So the industry then went to asset gathering. And then the rise of the asset gatherers happened over that period of time. But what the dirty truth is returns sucked. So nobody made any money any longer. And then what happened is, the moment you have an industry like that, and it happened to Alan in London, is the moment something goes wrong in your performance, you're under such extreme pressure by the investors who are the funder funds and pension plans now, not the family offices who didn't mind the 15, 20% volatility. Anything goes wrong and they bail. And Alan Howard went from 80 billion to 3 billion in a year and a half. It's extraordinary.
Wow, I had no idea. Now, you mentioned the kind of cut your losses quickly to keep your volatility down. I kind of think that that's changed the nature of trading in global macro, and that you do get this kind of mini herd, these little bubbles where everyone hops on something, and then the moment it starts to go against them, they can't take the pain. Do you think that that opens opportunities for non-institutional money, those who are willing to take a little more volatility and sit through it? And like, I'm thinking about your own personal trading. Do you say, I know that these guys can't take a drawdown, but I can sit through this, and therefore I'm going to take my kind of time horizon and lengthen it, and that is my edge?
Yes. So I looked at this, and when I was doing the hedge fund, I realized we were all doing 2-week trades.
Right.
Because 2-week trades, you try and make a bit of money, then you protect your P&L because you have to report monthly. If not, the pension plan will be on the phone saying, why did you screw up this month? So you became motivated to only show positive returns each month if you could. So it made everything ridiculous. So it didn't matter where you bought a security or sold a security. It only mattered, and how much money you'd made in it. It only mattered what your mark was that month. Right. So it's ridiculous. So as opposed to an annual P&L, you were going down to monthly. So I realized at that point that the actual arbitrage was time horizon, because nobody could have a long time horizon. So family offices were doing much better returns because they just didn't have the same restrictions. People who were managing their own money were generally doing better. Anybody who had to manage based on the volatility structure was not doing as well. And I'd seen it because I thought the best investor I'd ever seen was Nick Roditi, who was the other guy at Soros that nobody knew. And he was astonishingly volatile. He was probably 20-something vol. But, oh my God, his returns were huge. And he had some big losses in that too. But an amazing, amazing, amazing investor. And I realized that his edge in the whole thing was that time horizon. And I realized it for myself. So that's why I actually started the Global Macro Investor. Because I said, listen, I think the industry's wrong. I'm stupidly, I mean, who am I to say this? But I said, look, the industry's wrong. I think the industry needs to go to longer term time horizons, and I'm going to prove it. And that's why I started the Global Macro Investor. It was exactly that argument. Is I said, look, you need to, all you have to do is lower the size of your trades and stick with the long term view. Because as Paul Jones had told me, he said, look, what makes the best investor or the best trader is somebody whose idea horizon matches with their time horizon. But most people don't. Most people trade 2 or 3 week views and base it around their long-term macro view. I mean, that's nonsense.
Oh, you're right. Yeah,
so everybody does.
Correct.
Everyone says we're going into recession, blah, 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 and I'm then going to trade a 2-week view. Well, a piece of economic data in macro world is economic data. It only comes out monthly. You get one data point in a month. So it's nonsense. And this is what people misunderstand about so much is most people have a much shorter time horizon. And that's why I find it much easier to operate in a longer term time horizon, because I think over time you have an edge over the machines, because for a machine to try and understand the probabilistic outcomes of something in the future, let's say of the euro falling or whatever it may be, or treasury yields falling, it's impossible for them to process the kind of information, the textual information that humans do still. But for it to understand the flows and how to affect something in the next 3 minutes, they have a bigger advantage over humans. The longer out you go, the more advantage humans have.
Right. So what is your, like, can I ask, like, a typical trade for you? Like, how long are you thinking? Is it like that year-long process? Like, is it that long?
Yeah. So generally between a year, 3 months and 2 years.
Right. So
So
you're
it's
not
like treasuries, trades like that, I'll be in for a year, 2 years, and sometimes not even trade around them.
right.
And other times I will. It depends. Currencies I've traded around a bit more, but really currency. I mean, here's a great example of my view and how I think about things is, and again, I sound a little bit arrogant doing this, but back in whatever it was, 2013, the euro was 148.5. It had topped out, and I was living in Spain, and I'd seen the mess of what was going on in Europe. We almost lost our banking system in Spain at the time, and all the other mess. And I just thought the euro is way, way, way too high versus what it should be. And using the charts and using all the analysis that I do, I'd made the decision myself personally that, listen, I need to change everything that I do to dollars now. And so I changed the billing of Global Macro Investor and told all my clients, I don't want euros, I want dollars. I took all my life savings.
Were you doing the opposite? Were you doing the opposite of Giselle?
Yes,
I think Giselle was asking. That's right. She was asking for euros, and you were asking for, you say no more euros. I want dollars.
It was exactly that time, between that euro at 160, euro at 148.5 when I did it, and I switched all my life savings into dollars. I then forced myself to buy property. So I bought a house where I'm talking to you from today in Little Cayman, where I ended up building a house. And also I bought a small place in Miami. The point being is I then couldn't trade it. So I couldn't get in my own way because I thought there was a very high chance that the euro goes to sub parity against the dollar, probably goes to 80 cents. So I'm like, well, I'll do that trade all day then.
Right.
And that was
you made yourself illiquid, so you couldn't trade out of it. And I know that feeling all too well, because you are, as a trader, tempted to do it. Now, you've mentioned, I saw you nail the bond trade this summer, and I've seen a couple of things that you've said, and you've definitely lightened up on a trade. I know a lot of people talk about putting trades on, and less talk about when they take things off. And obviously, each and every investor is different. But can you walk me through a little bit of your process of how you decided, like, to take some profits and how you basically?
That's harder.
Yeah.
That's much harder than putting a trade on. In fact,
it is
extremely hard. It's extremely hard. The only reason I've had the levels of conviction in the fixed income traders, I've done it before, and I've seen it, and I know a business cycle. When you've got something anchored like a business cycle, you have a much higher probabilistic outcome. Now, maybe I'm wrong with the business cycle. Maybe, we flatten out here. Well, I'll have made a ton of money in the trade, and I'll come on to what will make you take it off in a sec. So when you're anchored to the business cycle, that does help significantly. But otherwise, it's very difficult to know. Like with Bitcoin, where the hell did I take it off? I put it on at 200. I took it off at 2,000. I thought I was a hero. It went to 20,000. And I looked like an idiot. So it is very difficult to know. And particularly, I find it very hard in the ones that, particularly with the single stocks and stuff like that, or even with options where you start to make multiple returns, 3, 4, 5, 6, 7, 8, 10x, because it completely consumes your mind in the end. It's difficult to see what it is. It was only the Eurodollar trade and the bond trade that I've kind of lived through a lot in the past that I knew better how to do it. But generally, as a rule of thumb, I use a whole load of technical analysis, trying to use the longer term stuff. So monthly DMARC, kind of monthly RSI divergence. If I'm in a big trend, I'll then look at how big the positioning is as a percentage of how big it's ever been in the past, versus open interest, to get some textualization. I kind of think through, obviously, what is anything changing? So there's a difference between taking profits or closing out a trade. Taking profits is a personal thing, and sometimes I just think, you know what, money in the bank's worth more than not having it at all, than the ability to give it back. So sometimes you just take profits because you want to. Other times it's because something has changed, and that also is very hard. You know, the biggest screw up I've ever had is when I didn't listen to my kind of framework that had changed. But when things change in your framework, you need to be honest with yourself. It is difficult. Putting a trade on is easy. Taking it off is really bloody difficult.
Yeah, no, you're for sure right. So a question for you. What do you think distinguishes a good trader from a great trader?
It depends what style you have. You know, I think there are some people who have left and right brain abilities, and that's a person to have the creative big picture thought, but with the attention to detail. And there's very few of those people around, and I'm certainly not one of them. There are some people who understand deep in the weeds and then the really big picture, and those guys can be very good. I find the actual answer to what makes a great investor, I won't use trader because it's a slightly different skill set, I think, is people who understand the knock-on effect. And that's so you don't look at what's happening today in the news. It's what does it mean for that, and what does it mean for that, and what could it mean for that? And that's where the money lies.
For sure. I completely agree. I have this great story that I tell about Norway when they found oil off the coast, and everyone was busy, you know, trying to find all sorts of ocean rights and investing in the in all the kind of Norwegian stocks that were basically going to benefit from this huge bull market. And there was a fellow that decided to come up and buy all the Norwegian artwork. And he realized that once all this money got turned into wealth, that the Norwegians would buy their own local artwork. So he was already kind of one step ahead of them and buying what was cheap and realizing what was going to go from cheap to expensive.
Yeah, I mean, that's genius. I love stuff like that.
Yeah, for sure.
And you know, some of the greatest trades, which we'll probably talk about later, have been about seeing the knock-on effect faster and more purely than anybody else. And that, to me, is when I see somebody do that, I'm like, okay, you are amazing. And there's some people who can do that very, very well.
Well, Raoul, you're selling yourself short because you do it all too often. For those who want to learn more and find out kind of your calls, where can they find you? Why don't you tell us a little bit about what you do at RealVision and what you guys offer?
Yeah, great. I mean, the easiest place to find me is on Twitter. Like you, Kevin, I'm very active. I share a lot of stuff. I think out loud on Twitter, so at Raoul, RaoulGMI. So you can find me on Twitter to start engaging. Also, if you are interested in the world of finance and learning from the greats or learning from others, then, you know, I built a business along with a few other co-founders called RealVision. I think most people have probably heard of it by now, which is essentially the Netflix of finance. And there we have the world's most famous investors, greatest analysts, and Kevin Muir on it, who are there to guide us all. And it's an open platform in terms of we don't have an editorial bias. We just want the highest quality people. We just curate them by their intelligence and their kind of value add to the community. So if people want to take a look at that, just go to realvision.com. There's a whole free version as well, so you don't even need to pay. But if you do, it's only $180 a year. So it basically costs nothing to get trained how to become a great investor by Stan Druckenmiller and everybody else you care to name.
For sure. And for those who haven't tried it out, make sure you go because you'll just be amazed at Raoul mentioned a lot of different names here in terms of famous people, and you'll find a lot of those people on RealVision. You know, there's a Stanley Druckenmiller interview that's one of the best that I've ever seen, and there's a whole bunch of things like people of that caliber, and I highly suggest that everyone go and have a look. Anyways, Raoul, thanks for joining us, and now I'm not going to let you go without telling me tales from the trading desk, and I figure you might have one or two that you might want to share with us.
Yeah, I'm going to give you two. One I probably mentioned before, and the other is I have never mentioned before, I don't think. So
awesome.
This is all one guy and he is one of the most famous hedge fund managers as well. For some reason, I'm still fearful of him to this day, so I won't mention his name. Because he was one of the most aggressive traders and pretty secretive. But and I've mentioned his name in the podcast so far. But anyway, this guy, I never forget, it was 1999 or 2000. I'll start with this story. This is the knock-on effect. Both of these are knock-on effect stories, and the other one is the story of somebody who understands detail, the detail side of macro and the big picture macro. So those are the two big attributes I said. So the knock-on effect story is the UK 3G telephone licenses are being granted to phone companies. The UK is the first country to grant licenses. Now, if you think of what 3G means, at the time it's going from your phone just being able to send a basic text and making a phone call to turning it into, the Apple phones of today. So every phone company knew that they had to do something to do with this. So there was a lot of chatter in the newspapers because people wanted to see how this auction went, who would pay for it, how much they pay. And the UK kind of set a price range. And the whole finance industry thought, they'll have to overbid a bit. But when the auction happened, which nobody'd ever auctioned off a license before, it went through at such a ridiculous high price. And everyone was like, wow, that's extraordinary. That's how much they paid. However, this famous hedge fund manager looked at it, understood what it meant immediately. What he meant was almost every phone company, every country in Europe was going to auction their licenses because it was free money for the government. And they were going to go at such extraordinary rates because everybody had to have this license. There was no choice. So they knew that the price would be extraordinarily high, and he just realized it was going to pretty much bankrupt all the telcos. And that was the end of the TMT, telco, media and technology. That was the end of the telco part of the equation. So he came on and said, and I started with him the entire sector business. You couldn't trade sectors in Europe, but at the time he came on and said, listen, how do I trade sectors? And I said, well, we'll figure it out. We created the sector swap market. It was before ETFs. So in the US, there was some ETFs in the US, but there was nothing really in Europe. So we developed the Dow Jones Eurostock sectors to trade. And he came on and sold $1.5 billion of telco stocks that day, of which nobody had figured it out. I mean, that's a big size at the time. And nobody had figured out what the hell was going on. And he'd just taken the knock-on effect of UK auction, not good for the UK phone companies. But if you're any of these global players like Orange or Deutsche Telekom at the time, they're totally, totally screwed. So he shorted them, and things fell 60 or 70% after that. And that was the start of the end of the TMT bubble. So that was one story.
That's a terrific story. You just get those guys who understand things, and then the ability and the courage to put that trade on in such size.
That's right. And interesting enough, I knew somebody else who'd like this chart, another famous hedge fund guy, and because we're talking about the trades, I try and not say who it was, but a famous guy who was very famous for charting as well. And I just called him up and said, and these two are both friends, and I called him up, in fact, very close friends. I called him up and said, hey, listen, look at this chart of the European telcos. I knew that's all I had to do. I said, look at the chart of the European telcos, and by the way, your friend's been selling them. He's like, fuck it, I'll do it as well. And so there was another $250 million out of him. He'd never traded a sector before, but I knew what could get him salivating, and it was a head and shoulders top on a chart that nobody else was trading.
That's funny.
And he didn't want to look stupid because he's smart, because his other mate was taking the aggressive trade. So that's one. So back to the Mr. Aggressive. So this is when he proved to me that he was literally one of the greatest traders I've ever seen. And he's not given as much credit. People don't talk about him as much as I have done. I used to know them very, very well. Their firm, they were by far the biggest client of mine when I was at Goldman Sachs. And it was the Asian crisis. And everything is going, it was an extraordinary time. And I was at Goldman Sachs basically controlling the order flow for all of the largest hedge funds in the world, seeing what everybody's doing across the world. It was an unbelievable time. So I get this phone call from this aggressive hedge fund that says, South Africa. I'm like, yeah, sell it. So I'm on the equity derivative desk, running the hedge fund sales business and equity derivatives. What do you mean South Africa, sell it? He says, just start selling. Slams the phone down. I'm like, okay. And then the line lights up again. Just whatever you do, don't sell futures. I'm like, so he's called the equity derivative desk, but he doesn't want to sell futures. He wants to sell stock. And I said, well, do you want the index? He goes, I just don't give a shit. Just keep selling them. So this goes on every half an hour. His head of trading calls me up, who was another very aggressive guy. He calls me up. He's like, how much you done? I'm like, it's South Africa. I've done $10 million. He's like, come on, we've got more to sell. So this goes on for 4 days of selling every bid in South Africa. And we eventually sell $500 million of South African equities. The market's in free fall, but all of the emerging markets are in free fall. So, it's total chaos out there. So I'm like, okay, fine. I don't know why he's doing it in this sloppy, ridiculous method. We could have done this much easier in futures. Maybe it was $1 billion. It was a big trade in South Africa. So that all goes quiet, and we carry on with the Asian crisis, and things get better, and the HKMA intervene in Hong Kong, and it starts improving a bit of sentiment, and things get better. And eventually, they come back, and he's like, "Buy South Africa." I'm like, okay, we can go through this all over again the other way around. And yes, we do, but a little bit less aggressively, and he closes the whole trade out. So I look at this. This is 3 or 4 months has gone by. So I'm looking at this, and I added it all up, put it into a spreadsheet, added it all up. And I'm like, he made 8%. I'm like, well, what was the point of that? Considering what was going on in the world. So I called him up, said, what the hell was that all about? All of the aggression, all of the thing, he made 8%. He goes, you kidding me? I've made 58%. I'm like, what? What have you done? He said, oh, it wasn't an equity trade I was doing. I said, but you were selling equities. He goes, no, you see, there's 2 currencies in South Africa. There was the financial rand and the commercial rand. One had the interest rates were at 27% because everybody was trying to break the currency, and between the two. So what the
he was
onshore
creating a
rand,
credit.
yes. So the onshore rand was trading, at very low interest rates, and he figured out he could basically get onshore rand by shorting equities because the stock borrow was 0.5%. So you short the equity, you get a pile of cash.
That is a great story. That is awesome. Like, that is really just shows the next level thinking, doesn't it? Like, just that He's just in another league.
Correct. I mean, that was extraordinary. I just felt stupid. Nobody else had figured that out. He didn't tell anybody, and nobody figured out what he'd done was a way to get round the problem of high interest rates. Because the story of the Asian crisis was, if you didn't lock in your currency forwards, by figuring it out in advance where this was going, you were going to get squeezed out of your trades as they jacked up interest rates. So it became really hard for people. The smarter guys managed to lock all their forwards in, 1 or 2 year forwards, and they could trade it. But if you want to come into South Africa in the middle of the crisis, you're going to have to borrow the currency at 27.5% or whatever it was, unless you figured this out. So super clever.
That is awesome. Well, thanks for sharing both those stories with us, Raoul.
Not at all.
Okay, at this point, we actually will have the special privilege to announce that we have a terrific second guest, and it's none other than Nancy Davis, who is the founder of Quadratic Capital Management and the portfolio manager of the IVOL ETF. Nancy, thanks for joining us today.
Thanks for having me. It's great to be here with you guys.
So we were just going through your your career, and you were telling us how you used to work at Goldman Sachs, and I was quite impressed that you were the head of credit trading and OTC trading. Is that correct? The proprietary group for 10 years, for a decade?
Yeah, as a head of credit derivatives and OTC trading for the principal strategies team at Goldman.
And so what was that like? So was that in the early 2000s, or was that what was the timeline that you were doing that job?
Yeah, I was at Goldman starting in the late 90s, and I was had that role in the mid 2000s where I was the head of trading for that team. So.
And then you quit Goldman and you went off and you founded Quadratic. Why don't you tell us a little bit about your firm and what you guys do, and a little bit about your product that you've launched?
Yeah, so Quadratic is an asset management firm. We're based in Connecticut. I started the firm in 2013. It's really the same investment strategy that I've implemented throughout my career, which is structuring directional portfolios with cross-asset class options. So we have Greek risk, but we're not trading implied versus realized volatility. We're taking directional views, and we're using the options to risk manage those views.
Okay, and terrific. And what is the IVOL product itself? Like, why don't you just give us a brief kind of history, like not history, just kind of a bare bones description of what it's trying to accomplish?
Yeah, the IVOL fund is a government bond fund, so it's a fixed income fund. It's listed on the exchange. Most people hear ETFs and they think passive index replication strategies. This is actually an actively managed ETF. And what we do is we seek to profit from relative interest rate movements, whether that's Fed rate cuts or rising long-term rates. And we provide inflation-protected income as well that is potentially enhanced above just regular government bonds. And then we're also, because we're buying options within the fund, we're also long fixed income volatility, so we have the potential to benefit from market stress as volatility increases.
So I'm going to jump in here, Patrick. When I first saw IVOL, I must admit that I looked at the different kind of aspects or characteristics of it, and it was just kind of seemed like I joked about it, calling it my dream ETF, because it had basically a steepening aspect, it had a real return aspect in terms of the tips, and then it also had a fixed income long vol aspect. And to me, those were three kind of very attractive characteristics, because over the long run, I think all three of those trades are going to be winners. So I've followed it very closely and been a huge fan. How have you found so far? Like, what has been the response, and what are the challenges that you've as a kind of an ETF manager have been pushing up against?
Yeah, I mean, I think most people who invest in ETFs are used to stocks and then credit strategies. Like, there's a ton of AUM, and whether it's emerging market bonds or high yield or investment grade or bank debt or floating rate notes. But in the rates market, there's not a ton of innovation beyond just government bonds. So we're really excited about bringing, the biggest asset class to the ETF world. But the challenge with doing something new is people don't really know, where to put it. So that's been one challenge. It's a lot of education. Also being, a small new entrant to the world of 40 Act funds. It's a bit of a process to kind of get the name out there. So we really appreciate Kevin and Patrick, your support and the opportunity to be on this podcast and at least let people know to check it out and do their homework and evaluate it if it might be appropriate for their portfolio.
Yeah, one of the things that I'm most attracted to is the fact if you go to your website, the IVOLETF.com, and you go to the tab that says IVOL, you can go down to the top 10 holdings, and you can see what's actually in the ETF. And what you'll realize is that a lot of those holdings on the options are options that are available only to institutional investors that have the kind of ability to trade using what's known as an ISDA. And for most retail investors, this isn't something they're able to do. And even for me, that's I trade a lot of fixed income. I have no ability to go out and basically get long a curve steepening option. And this is why your product is just so unique and something that people should really kind of have a look at, because this is fantastic. The fact that I had no idea that these things were so available and kind of so tradable. And not only that, let's talk a little bit about the opportunity in those curve steepening options. And we won't talk specifically about kind of the ones that you own, but let's just talk about why you would own an option on the curve steepening as opposed to just on volatility on the index or fixed income as a whole.
Yeah, no, definitely. I'm excited to talk about kind of how it's made and what it does, but maybe just to circle back on your point about having it be, we really see this as an access product and a way to, bring, I like to say that, anybody can trade a stock or a bond or a listed option on their iPhone even. You don't need you could do that very easily with listed markets, but bringing the world of fixed income and an OTC product to the ETF wrapper, we see it as, you have the transparency of a separately managed account because every day the portfolio holdings are disclosed. The strategy is very clear about what its goals are and what it does. But it also gives access. I feel like we've become, I hope to become kind of like the convenience store for Convexity, where we give kind of everybody access to this market, which is it's a really great time too. Obviously, it is an all-weather trade, and we, expect it to be, when we actually do have a steeper curve, it's probably when people are going to be worried about inflation and all the money printing that we've had for 12 years. But right now, with an inverted yield curve and this type of fixed income volatility is trading at about 2 basis points a day, it's super compelling.
Absolutely. And, Nancy, what I find interesting as well is that when you're playing the steepener, it's also it's a byproduct of the market cycle, which is that often during a steepening, often it's associated with a recession and bear markets or even weakness in real estate. And so there's all sorts of different really interesting aspects of holding this as a hedge, not just as a play on the steepener alone, but also as a hedge for your whole portfolio. Is that a fair way of looking at it?
Yeah, definitely. I think it's because we're long optionality inside the ETF. It gives that protection against, if there is a market correction. Historically, when we've had these sell-offs, like big sell-offs in the equity market, the Fed will come in and cut rates. So that will typically make the yield curve steepen. So you get the directional wing there. Plus, it's long government bonds that are inflation protected income. So you have the good carry as you're not waiting for something bad to happen necessarily. And the neat thing about this type of, curve trade is that it also works in a risk on environment. If we do have the Fed normalize inflation expectations, and we do have a normalization of the yield curve. So it's kind of got like the tail-like properties with the income, but also if we have a super, kind of risk-on environment, it should perform well in that environment too.
So Nancy, I can't help but to ask your opinion about what you think is happening in the funding market. As we tape this, the Fed has had to come back in and do another $75 billion in repos overnight. What do you, you have a lot of experience, trading at the front end of the curve and watching all the different things. What do you think is happening, and what do you think are the consequences of that?
Yeah, I definitely think it's a really, it's sort of a flashing sign. It's a red light for investors to be aware of. Also, the inverted yield curve, the slide that you have off right now, it's historically been an indicator that a recession is coming or a recession is near. But I think of repo as the grease for the wheel, and when the wheel starts turning, that's when we have the, you fly over the handlebars and crash. So it's definitely maybe a bad analogy. I just made that up. But for those of you who like biking, it's definitely an unhealthy sign, and it's something people need to be watching and aware about.
So I've kind of been of the opinion that it's the market's underappreciating what the concern in it. Yesterday at the FOMC, Powell seemed to dismiss it as well. Do you think the market is kind of ignoring it, and is that going to be a worrisome sign about maybe that there's too many, the animal spirits are a little too frothy, and that we should be paying more attention?
I think it depends on the asset class. Like, in my opinion, the rates market is usually the first one to kind of, if you were going to say which is the smartest market, I would say it's the rates market. And the rates market is definitely, not happy, and definitely saying, the bond market is screaming that something bad is about to happen. I think the other markets, whether it's the private side, private credit, private equity, or public equities or public credit, those markets seem to be kind of humming along, like everything is fine.
It's that saying of nobody cares till everyone cares, and then everyone cares all at once at the same time, right? And it'll be interesting to see when these other markets start to think that this is important.
And so, Nancy, the other question is about the yield curve. Do you think that with all the distortions that are happening in Europe, with the negative rates and the hunt for some duration from European and even Japanese bond managers, do you think that there's a chance that the yield curve is broken as a sign of economic, a harbinger of what's to come, and that maybe this summer's kind of duration spike was not really a problem with the economy as much as it was just this crazy, bid for fixed income due to the absurdity of monetary policies overseas?
I know a lot of people say that and they're blaming it, but I also think if you look at global yield curves, France has an upward sloping yield curve, Germany has an upward sloping yield curve, the US has a more inverted yield curve than even Japan or the UK. So I think maybe that's the case. It's really hard to say. I can't speculate, but I think it's also, for us, we see it as a tremendous opportunity for what we're buying inside IVOL, because it's, basically, the real yield exposure from the tips. So we want lower real yields, but also the curve steepening, whether that happens from, hey, we're going into the next recession and the Fed needs to cut dramatically more, or maybe they're successful in, stimulating the economy and we actually have a normalization of inflation expectations.
Yeah, I'm torn because I can kind of see both sides. I see what the market's all worried about, and the fact is that the U.S. is still the tightest monetary policy out there. Yet at the same time, I see the economy and I think to myself, hey, it's not that bad, and we're still sitting there with unemployment, at all near the lows, and the global manufacturing looks bad, but when you drill down on the actual economics in the U.S., it doesn't look that bad. Do you so for you, you don't care whether it's like the fact is whether the economy rolls over or whether it gets going. You're just more concerned about the fact is that the yield curve is inverted or very close to inverted in some cases, and that the risk reward of that trade just makes sense and it'll eventually kind of normalize. Is that kind of your thinking behind it?
Yeah, exactly. I mean, we saw a need to really give investors access and democratize the financial markets and bring new products and innovation into the world of ETFs. And we do really love the ETF vehicle because, especially in the world of active ETFs, it's has all the benefits of being a separate account. It has much lower fees. It has transparency. But at the same time, the yield curve is inverted. The type of volatility that we're buying inside the fund, it's about 2 basis points a day, which is significantly cheaper than any type of listed option vol, whether it's treasury options or, some people look at, equity ETFs that trade like TLT. It's much cheaper than that. And even swaption vol, which is what even institutional investors typically access. This is a 1-year, 10-year at-the-money swaption right now is about 4.2 basis points a day. And an at-the-money forward for same tenor in what we're buying inside IVOL is about 1.9 basis points a day. So it's a pretty compelling time, whether you think it's going to be a normalization and we're going to have risk on and the Fed will be successful in stimulating inflation, it's a good time. Or if you think we're on the, cusp of a recession and the market's going to go risk off, either way, the asymmetry is attractive.
And the other thing I'd like to say, just for the people that I really encourage you to go and dig into the holdings, you'll notice that the vast majority of the fund is actually in what's a TIPS ETF that you hold. So it's in essence kind of the most of the principal is actually very safe, and it's just the kind of at the margin, I guess, basically 14 or basically a little more than 13% is invested in these really cheap options. And in doing so, what that does is it really offers a situation where the TIPS are earning a yield in the meantime. And then if the curve steepens, as both you and I hope, Nancy, that payoff will kick in at that point. And I encourage people to go look at it and understand that, because it sounds scary. It sounds like, oh, geez, it's betting on interest rates and curve steepening, but it's not actually as scary as it seems. And I know I'm not going to ask you to comment on that, Nancy, because I don't want you to be forced to talk about the risk return, but I do want people to go, and I do encourage them to go learn about it, because it really does offer a very unique, interesting vehicle.
Yeah, no, thank you for that, Kevin. We do see it is a government bond fund, and then it has an enhancement. And I think in terms of portfolio construction for investors who already own U.S. inflation-protected bonds, TIPS, this is just an enhanced portfolio, and we see this as enhancing with options that are on inflation expectations. And so if you like, TIPS, why wouldn't you want to have these options that are, the expectations, which are priced in, with such negative, it's priced for disinflation for the next decade.
Right. Makes
sure.
sense.
Well,
Yeah.
Nancy, I just want to thank you for coming by. It's a pleasure getting to know you and telling us about your products. Why don't you just tell people where they could find more information and let people know where they should go?
Yeah, feel free to email us at investor.relations@quadraticllc.com, or there's a contact us on the fund website, which is www.IVOLETF.com, and we'd be happy to take any questions. And it's also in Bloomberg. It is an ETF, so really anyone can access this unique market.
That's right. So again, it's IVOL. If you want to trade it, it's IVOL on the New York Stock Exchange. And Nancy, it's been a pleasure having you and meeting you. Thank you very much for your time.
Thank you, Nancy.
Thank you, Patrick and Kevin. It's been a real pleasure. Appreciate it.
Take care.
Take care.
Thanks. Okay, Patrick, it's time for This Week in Trading History. What do you have in store for us this week?
Well, this week we're going to go to one of the more famous stories on Wall Street, and that's when Soros broke the Bank of England. And what's interesting about this story is that a lot of people, make Soros the centerpiece of it, but it was actually Stanley Druckenmiller that was actually the one that was the key one that discovered and started to put on the trade, right?
That's right. It was actually Stanley's trade. He had the trade on. And what Soros's genius was recognizing the unique opportunity that was offered to him. And what he did was he had the courage to be a pig and just put it on in size. And
right.
But it's kind of Stanley often just gets he ends up being a footnote, but the reality is that the trading idea actually originated from Stanley, who I think is the greatest trader that's ever lived. I actually, as much as I'm a fan of Soros, I actually think that Stanley's better. But
one day he'll be on the Huddle, right?
That's right. One day he'll be on the Huddle, but not after he finds out what you were calling him for many years.
Oh yeah, I misread it early on and called him Stanley and Druckenmiller before. But
yeah, that's right.
Perfect for the Huddle. And,
that's right.
So anyway, let's start off by just quickly bringing everyone up to speed. With what the ERM was. First of all, in Europe, there was the exchange rate mechanism that was put in place to introduce European economic unity. And it's a process of working up to the European Union that we know today. And it was to reduce overall the exchange rate variability between these countries and to encourage stability. And it was this idea of a pegged currency system, but it's a semi-peg, which is had some variable within the currency exchange rates within set margins. And really what it comes down to in the most simple form is that Britain just simply entered the ERM at too high of a price, something like 2.7 marks to the pound at the time. And Germany was struggling because in the new unification in 1990s of East and West Germany, they were dealing with all sorts of inflationary pressures, all sorts of different things, and the UK had too large of a deficit, and their currency simply was too expensive. And ultimately, what it came down to is Soros and Stanley realized it was just not tenable for them to stay pegged at this level, and that inevitably the British pound would have to drop. And so what ended up happening was the British government ultimately was forced to withdraw from the ERM mechanism at that price. I think they had like a staggering loss of like $3.4 billion. That was when $3.4 billion was a large number,
That's right? Yeah,
like,
that's right. So Patrick, one second before you go, when was this? Like, most people sit around and they think about Britain and having its own currency, and it's actually kind of amazing to think at one point they were trying to have the euro currency.
Yeah, no, absolutely. And so when this actually happened, I was just about to get to this Black Wednesday, this actual event. It was September 16th of 1992. Was when the Black Wednesday occurred, where the speculators broke the pound, and so it was in the months leading up to this Black Wednesday where Stanley and George Soros there were building these huge short positions, betting that the pound will have to fall out of that band. And it's no different than, I think it's like a big victory lap, or not victory lap, but this big thing that every big money manager wants to do is catch some big macro trade like this. Like I'm curious as to whether or not, like for instance today, the Hong Kong will eventually have to have its currency leave a peg, and how many hedge fund managers are trying to make the big bets on that one, right? But this one was actually one that worked, and Soros basically comes in there, and they put on this massive trade, and they made something like $1 billion in one day, or just in a few days, from watching England having to leave the ERM.
Yeah, I'm pulling up the chart, and for those who want to pull up the chart, you have to do Great Britain like the pound, GBP, and you can't do it against the euro. You got to do it against the Deutschmark. So you have to put in DEM, and it's been a long time since we've traded Deutschmarks, but you can see that it was trading at 280, and in the space of a week, it kind of fell to 240.
Yeah.
And it was just kind of shocking. And one of the things that people don't realize is that how can a hedge fund take on a central bank? And one of the things that in this day and age, most central banks are trying to get their currencies down. Like, so you get like, if you think about, nobody wants their currency to actually rise. Most people want their currency down. So when you get a situation like in the old, like it wasn't that long ago that the Bank of Japan used to go and intervene. But the thing is, when a central bank intervenes on the sell side, they technically have unlimited firepower. They can create as much of that currency as they want. But when they're defending a currency, they actually have a limited amount. And so when Soros saw the fact that the bank was spending their bullets defending the currency, he just plugged them, like he filled them in like a butter tart.
I think there was in the Hedge Fund Wizards, the book, there was one of the traders in there talking about it because it was working on a currency desk or something, and it was supposedly the Bank of England announced that they had like $10 billion to defend the pound's exchange rate in the ERM, and Soros kind of conveniently said, "Well, isn't that interesting? Because that's exactly the size of the position I wanted to take."
Sold to you.
So exactly, and well, it was a great story anyway. But it's one of the famed trades of all time, isn't it?
Yeah, no, it's definitely one of those classics that immortalized Soros in the history books as one of the all-time greatest traders that's ever lived.
Absolutely. So let's move on. Time for the WTF clip of the week. And well, Kev, you're a master at this. Give us a warm up on what we're about to see.
Well, I saw Steve Leisman on TV talking about the Fed and what they wanted. And first of all, Steve Leisman looks kind of much like me with his haircut. And I realized that he also looks like another guy who reminds me of, and it's that George on Seinfeld. And when I saw him with this line, I just couldn't help but meld those two together. So let's hit play, Patrick. Let's see what we got.
All right.
What the hell is this?
Asked a money question, Steve, about the repo market. What'd you make of that and everything else that Powell said?
George, Elaine and I went to see Huddle with Jerry. With Jerry. Great.
I think there's some news there to the second half of my question where he said we may have to begin organic balance sheet growth sooner than we thought. And I did see, by the way, yields come down when that happened briefly, and then they seem to resume their rise again.
Probably went to the 84th Street. That's where I always go with Jerry.
Hello, and welcome to Movie Phone. If you know the name of the movie you'd like to see, press 1.
Come on.
I have sort of lost a little bit, Sarah, as to what the market wants from the Fed here.
Using your touch-tone keypad, please enter the first 3 letters of the movie title now. You've selected Agent Zero. If that's correct, press 1.
What?
I think going into this meeting thinking that the Fed chairman was going to pretty much do what the way Paul McCulley rather eloquently described it, and I think it was actually a little less eloquent than that, which is basically we'll see.
You've selected Brown-Eyed Girl. If this is correct, press 1. Why don't you just tell me the name of the movie you selected?
We'll do a cut and we'll see. And we'll do another cut and we'll see again.
Channel?
To find the theater nearest you, please enter your 5-digit zip code now. Why don't you just tell me where you want to see the movie?
But it appears as if the market wants some form of strong pre-commitment that the Fed is going to do something that it doesn't feel, at least at this point, it needs to do and doesn't have the data to justify.
Lowe's Paragon, 84th and Broadway?
Channel is playing at the Paragon 84th Street Cinema in the main theater at 9:30 p.m.
Yeah, now I got you.
It's also playing in theater number 2 at 9 o'clock.
Do you remember that episode?
Yeah, I do. Yeah, I do. That's a classic, and so, you know what? It's amazing what's going on with the Fed, though, right? Like, they continuously, at least now, they're not really signaling where they're going next. Or do you have I mean, I know the market is calling that they're going to keep cutting, but they haven't in any way indicated that, have they?
You are correct that the Fed is actually keeping it open in terms of where they want to head. They're not committing to any sort of rate cuts. Yeah. And that's part of the problem. The market wants more. And not only that, with these problems with the repo market spiking, there's a real question about whether they're too tight and offering not enough liquidity. So it's the Fed is clueless, and they don't realize that they're just not listening to the market.
Absolutely. All right. Well, let's move on. Kev, it's time for the top 5 things to watch next week. But before we do, we have to review last week's top 5 things to watch. And, well, we have a little bit of shaming, right?
Yeah, we have the walk of shame to do.
Walk of shame. We should even play that video clip in here. But it's, you know what? We were sloppy. Unbelievable.
Well, I can't tell a lie. It's Patrick's responsibility to do this part of the show.
Throw me under the bus. Honestly.
That's right. No, it's a team effort.
Yeah. But it's really Patrick's fault.
No.
Anyway,
And for those who don't know what we're talking about, we put our top 5 things to watch, and then we missed the number one thing that was on everyone's lips, which is
the FOMC meeting.
Yeah. It's not like that wasn't going to be important.
No, it wasn't. Actually, in the end, it didn't end up being that important, did it?
But that's true, actually. So more.
See, I just knew that. I knew it wasn't really important.
You're wise beyond your years. Okay, so
all right,
let's talk about the rare
number
earth.
5. Now, what's interesting is I had a few members that kind of raked me under the coals for this one, basically saying that, that really rare earths are very sensitive to the economic cycle, and that you can't really be bullish rare earths and bearish the economy. But, the one thing I wanted to just point out on these rare earths is there is no correlation to the economy. There's been just straight down for this, right? Like this has been a nonstop bloodbath since 2011. And so anyone who says this is correlated to the economy has not looked at the last decade of charts on this
Well,
thing.
Patrick, we have to be kind because they are your members, but I would agree with you that there is very little correlation between rare earths and the economy, and that you could very much. I worry anytime people start to say that the stocks of a commodity are going to move with the actual global economy. There could be things happening that make it very much independent, and be careful about that kind of. Like macro relationship. Of course, it helps when you have a tailwind of a good economy at your back. But maybe the fact that Patrick's bullish on rare earths is because he's wrong about his economy call. But anyways, let's go to number 4, the turn in the consumer staple stocks.
Right. And so the consumer staples, well, listen, all we were just asking was the question, are we going to see these finally run out of a little bit of steam? This is the XLP, which is the consumer staples index. But really, it's been a muddle. But, the stock market actually has been relatively strong this week, going right back towards 52-week highs. And really, this is not caught the bid very well. There are things that are doing better, and I'm still suspect. I think that if there's a legitimate chance the S&P could rally here, and I don't know whether you want to be bulling it with consumer staples. There's probably a few sectors that are probably going to have a much better participation. What's your feeling on that?
It looks like chop to me. It's one of those things that there's it's just kind of a noise, and it's porpoising, which means just up and down around the same level, which is boring and tough to trade. Rangetrader.com. There you go. Number 3, breakout in palladium and beans.
Right. So let's have a quick look at this. I'm just going to quickly get to my commodity stuff here. So what's interesting is that overall the palladium chart looks pretty good, right? It's held in. It's back up, almost ready to go to a 52-week new high. Oh, actually, it was that last pop. So it's been holding at higher highs. And so what's interesting is that there's been in palladium a pretty legitimate bull market already going on for several years. Yeah. This is a metal that has not waited for gold to turn to start being bullish, and it's been running. And I still think it's a pretty good one to remain bullish, right?
So, Patrick, I don't practice the dark art of technical analysis, but I look at this and I think to myself, how can you not love that chart?
Well, absolutely. And you know what? Everyone's drawing the Bitcoin kind of horizontal triangle pattern, but I like this horizontal triangle pattern much better. And this one looks cleaner. It's more of an ascending triangle that's ready for some upside. I think we could see 2,000 on this. It looks good. It looks good. But otherwise, I wanted to talk about the beans very quickly. Now, listen, I know this. You've tapered your enthusiasm on this space a little bit, but that breakout candle, which brought this to my attention, has held up pretty well. Now, I don't know whether or not this means that we're going, north of 950 or something like this, but I do think that this can continue back up to the year highs the 2019 highs near 930 or something. I still think there's room for this to go a little bit.
Okay, I'm not going to disagree with you there. I just, I was looking for the big one, and to me, if it grinds higher, so be it. I'm not going to take any argument with that.
Anyway,
number
the Euro
2.
bottom.
Yeah, let's look at this.
Well, you know what? What a chop these currencies have been. Like, so indecisive ever since last week. It's been like a game of ping pong, back and forth between 110 and 111 on the euro. Just massive whips higher and lower with no conviction. But the one thing I will say is the downtrend is still intact. And so until the downtrend has been beat, I'm going to draw that little trend line connecting all the highs, just the way junior and senior technicians do. I usually always comment, but anyway. Until we've broken that out, then you have to respect the predominant trend remains downwards in its trajectory, and it'll be very interesting to see whether the euro establishes the bottom here or whether or not there's just going to be more continuation to the downside.
I'll sum it up like this, Patrick. So much pessimism built into that thing. The surprises are going to be the other way. They're going to be to the positive. But anyways, you know what?
Yeah, you were right about that on the pound. Yeah. And so I mean, that's that you certainly have. You're definitely speaking. It's very consensus to be short the euro. That I'll agree with you. All right, but okay. Amazing how long trends last.
Yeah, especially in currencies.
Yeah.
And they last, you know what, the best sign that it's going to end, it's when I give up on it. So, number one, momentum value shift.
You know what, this is kind of calmed down since we brought it to everyone's attention, but it's still one of the most important things to watch in even the next month or more. Is there a major sector rotation? Because it's not just whether the market rallies or doesn't rally, but it's about what sectors will drive it. And where is the money supposed to go? I mean, is it going to be the same sectors that have been working for the last year, or is it going to be those kind of value sectors and the financials and other things that will make it run? And so I'm still fascinated as to whether what we witnessed last week was a real game changer or not. I don't think 1 week is enough to let us know whether that's the case. What do you think?
I want it to be so. I want it to be that was a game changer, but let's face it, the action has been pretty muted and not really that exciting. And it might have been, looks like, there's a chance.
But that was such an extraordinary move, Kev. Like, it was such an extraordinary move that it's got to spend a little bit of time kind of basing after such a move. And what to me is going to be is if it can't recover to where it was before, then it's something has shifted. Right? Like the fact that it's stabilized means nothing to me. It's about actually whether it can recover. And if it can't recover, then some form of a new trend may have be underway, right?
So here's what I think, Patrick. I think 2 years or maybe 3 years from now, I'm very confident that value will outperform momentum. 2 or 3 months from now, I'm not sure.
See, okay, so like look at this chart right here. This is the momentum value thing, and you could see that was a big drop. This is not an impressive bounce.
I guess you're right. I shouldn't get that upset just because it's not continuing to scream my way. I shouldn't be that
right. Like what I would basically say is like, okay, look, if this is back up here within a month, then maybe it was nothing. But I mean, if we consolidate down there, then that may be still a shift, right?
Okay. Well, Patrick, you talked me into it. I'm going to put more on.
All right. Top 5 things to watch next week, Kev. So let's jump right into it. So number 5, we've got some more of these European PMIs. The pessimism is maximum in Europe, and Draghi's reign is over. Is it really as simple as bringing a change of the guard and suddenly the sentiment toward Europe can shift that quick?
So I'm always interested in what's baked into the market versus what it's actually going to happen. Like, so I think you guys, as we spoke about the euro, there's a lot of pessimism built into the European market. Even if they just stop doing things wrong, everything might rally because it's so many people think it's the end of the world there. So many people are convinced that it's just going to, descend into a deflationary collapse, and that anything short of that might actually cause the euro to rally, might cause the stocks to rally. And interestingly enough, Patrick, have you looked at our little DB lately?
No.
I don't want to goocher it.
Yeah, you're totally going to goocher yourself, but it's actually
I'm going to goocher it.
So okay, but let's take a look because listen. In all fairness, I took a victory lap when it was down at
I know
below 650. I Gucci'd myself. So I want you to counter Gucci it by taking your victory lap here. Quickly.
Not a chance. Until this stakes in my belly, it's still fair game. You could win, and there's no way I'm going to tempt the market gods. But let's just go to the European PMIs. I suspect they're going to be bad, but they're not going to be as bad as the market expects.
Market is already priced in, yeah.
And that's what I still contend that on the whole, it'll be bad there, just not as bad as the market expects.
And what's interesting is that they're all coming out Monday morning for us out in North America. So it's a Sunday overnight. So we're going to really see the market impact right at the Monday market open, if there's any impact at all. But it'll be interesting.
Watch for it Monday morning.
Yeah. So number 4, U.S. GDP. And, we have this is something interesting because what we have is a global manufacturing recession that has never manifested into itself into a slowdown in the GDP numbers, at least not in any meaningful way. And I keep waiting for these GDP numbers to downtick, and they don't. I mean, are we getting another 2% number in here?
I don't know, Patrick. Like that, to me, GDP is like one of the worst economic numbers to look at. It's a backward looking that's based upon other numbers. I just think by the time that even if we get a downtick in GDP, by the time that we actually know the official number, the market's already looking past that. So to me, I almost think it's the top 5 things to watch.
It is the
but I think
indicator.
I think it's just it's gonna be if it's an outlier, I think you fade it. Either way, because it's a lagging indicator. Anyways, number 3.
Yeah. Number 3. Now, this is an interesting thing I wanted to talk about. So one of the big shifts, and it was not only your little shift in Deutsche Bank, or even the big rally we saw in Canadian banks. I'm sure. There's a big short guy that is a little upset about his long-term short holdings of Canadian banks, but
no, because the U.S. banks are doing well.
No, but Steve Eisman.
Oh, I thought you were talking about me.
No, I was. You put yourself in the same league as Steve Eisman. Hey, all right. All right, but he's been outspoken about those Canadian bank shorts, and they seem to have been going straight up since then, right?
Yeah, but he got his face ripped off.
For a very short-term period, absolutely. But one of the big things for me is that one of the big rallies in once that momentum value shift happened was this big breakout in JP Morgan, which is pretty much pressing 52-week highs. I believe, that is 52-week highs. And what I'm so interested in, we'll talk about the S&P broadly, and the thing is that is JP Morgan going to join like Microsoft as like the leaders, the generals in another advance in the market? Now, every bone in my body is bearish, but I'm a trader like you, and if the market wants to go higher, what business do I have getting in its way? What's interesting is that is there a changing of the guard? Will these banks actually be important in the next phase of a rally, if there is a rally? What's your feeling? Is this a breakout for real?
So I don't think that we have to have a situation where the market screams higher because banks are headed higher. And I go back to the idea that if all of a sudden we could have a situation where JP Morgan and Citi and all these banks are headed higher and Amazon, Microsoft, and Facebook get crushed. So I don't although I understand your argument that banks are often the kind of, signal for the economy. I just don't think that those things work as well as they used to, especially in this age of lots of different ETFs that have different styles and things like that. So although I am bullish on the banks, I don't think that means that you should go buy the U.S. stock market with both fists.
Okay.
And in fact, I would almost say I think that
focus on the banks more as a sector play.
I think the banks are going to listen. I've been bullish on the banks for a long time. But
let me rephrase the question then to you.
Yeah.
Okay, let's say the S&P's going to 3,300, is JP Morgan and the financials going to be one of the top 5 performing sectors? Let's say top 3 performing sectors.
Yes.
Okay.
Without a doubt.
Okay, then you. Anyway, you answered my question. Your question, the answer to your number 3 is yes, it will be based on your opinion. I'm not going to actually. I'm not even going to take the other side of that. I mean, that's definitely in my mind a possibility.
I could also see a situation where JP Morgan screams higher and the indexes go nowhere to down. Yeah.
Well, you know what? It's a very good possibility because I'm massively underweight these financials. So the market leaving the bus leaving the station without me on it is actually a very very high probability right there.
You should buy some Deutsche Bank. Number 2, to hedge your stake bet. Okay, so this is mine because we were talking about top 5 things to watch next week. I think it's really important to watch the response from the Saudis and the U.S. to the bombing of their energy assets. And the question is there a military response or is it purely just
sanctions and
things like that?
I think
I don't know, but I don't know. I'm not predicting. I worry that there will be a military response. I don't think that that's the proper bet, but I worry about it. But I think it is a top 5 things to watch because it's going to really dictate the tone of it. If all of a sudden there is a strike, which, I don't know. What would you give the odds? I give it maybe 1 in 5. But that 1 in 5 has an outsized reaction because I don't think the market is ready for that.
Well, I'll tell you, if it is a 1 in 5 chance that there is one, I suspect that it would not be the U.S. military, though. I think that
I agree with you. I don't think it will be the U.S. either. But I'm just saying that an escalation of military tensions is not expected by the market. I think you get a situation where oil really spikes and holds. And I'm actually nervous about that the market is not ready for it. To me, it's all about what the market is expecting and ready for and what's priced in. And there seems to be no worries about this. This doesn't seem to be on anyone's radar.
I'll tell you right now, I feel that reflected in oil, the fact that oil, when it hit, like, let's say the WTI went like 62, then dropped back down to like 58. And the fact that we're seeing oil backing off is this idea that things have de-escalated very quickly. And I think that if the outlier chance that something does happen, like, I think there's another full leg higher coming in crude.
Yeah, I 100% agree.
Yeah,
I think that it would just be the start, and we look back and go, "Why were we so dumb?" But I'm not predicting that. I'm just saying that that's the top 5 thing to watch.
All right, Kev. It's now number 1. I wanted to ask that important question. S&P 500, is this going to finally break out, or is it going to reject along its previous high? And it's fascinating where we are and when we are here on this S&P. So we're literally trading very close to that 52-week high, haven't broken out to new highs, and we're going into that quad witching. Right, we're going into where a number of really smart quant guys were talking about this huge gamma exposure on the S&P options that are dragging or pulling the market up into this 3,000 to 3,050 level. But all of that over the weekend rolls off, right? And
if we remember back to Scott Murray, he was, the volatility whiz. He said that this is the typical playbook, is that it rallies into expiration and then sells off after the expiry.
And so the thing is that what bothers me about this is that it's this whole idea that we're going into a recession and it has everyone materially underweight the markets. Everybody seems to be positioning defensively like this is a money in the bank, and then you have quad witching rolling off. You have the blackout window for corporate buybacks coming in as we approach earnings. Everything says this market should give back, and even just talking about this repo and the fact that the liquidity is being drained, going back to Barton, like, we have all of these things driving. And the question I have for you, is it this easy that, hey, we'll just short right here and it's money in the bank to the downside? That bothers me, that it almost seems to be too perfect of a setup. I almost feel like the market go higher just to kind of wash out all these people that think it's this easy. No?
Well, so Patrick, it's funny that we've almost changed rules here, because I'm going to say that I am worried about it. I do think that the chances of it rolling over are much higher. I think the market is actually very complacent given the worries that are happening in the repo. And I look at this and I think to myself, if we do get a breakout, I would fade the breakout. I think that this might be a prairie dog if we get a breakout. And then not only that, I'm not even sure that we do get the breakout and that it doesn't just follow the script like Scott Murray and many of the other kind of quants have been saying, that it just rolls over.
Well, you know what? I don't want to
So,
go through that for you, so I'll take the other side of that. I feel that the market needs to first wash out all the weak hands that are jumping onto the story. And so I actually think that the market actually first pops higher, kind of cleans out all the shorts as everyone takes the parade for the 52-week new highs and bull market is resuming, and then the rug gets pulled out when everyone is the worst positioned for it.
So a breakout you think actually has legs? It won't be just a classic. It won't be
long enough to fake everyone out, and so let's see. But listen, there's no doubt that with quad witching, corporate buybacks, this liquidity stuff, everything is saying that this should be a double top. And is it that easy? That's the only question I'm asking, right? Like, I'm personally straddled, so I couldn't care less which way it goes. But you know what? Let's see whether it first fakes out on the upside.
Okay, well, there you go. If there is a fake out, I think it'll be short-lived and it'll actually be at most a day or two.
All right, let's move on.
Okay, parting wisdom. I'm going to give you a Michael Marcus one, Patrick. I actually like this one, especially with Raoul talking about all the different his trading experiences, and I thought this was a really great one for us to look at. Every trader has strengths and weaknesses. Some are good holders of winners, but hold their losers a little too long. Others may cut their winners a little short, but they are quick to take losses. As long as you stick to your own style, you get the good and bad in your own approach. And that's Michael Marcus. And I thought that was so important because, you and I are a perfect example. We might often disagree and have almost, opposite views, but yet hopefully we both figure out how to take some money out of the market. And one of the keys is to basically be true to your discipline, be true to what's your stop losses, the way you trade. And if you try to do someone else's, like if I tried to trade like you, it'd be a disaster. And if you tried to trade like me, you would go insane. And that's very, very important.
Yeah. You have to develop everybody. Your manifestation of the markets and the way you trade is all about your own experiences. And what happens is if you try to force someone else's experiences into your trading style, you have a disconnect. You have to be true to yourself, and you have to learn from the markets, and you have to develop your own process of the way that you understand the markets. And if you try to use other people's techniques rather than your own, it often doesn't end well, does it?
You're absolutely right. You can learn from them. You can get ideas.
Oh, you always have to learn from everybody,
right?
But you have
ultimately you have to be true to yourself.
Yes.
And that's the important part. And I think it's a great tip from Marcus.
Michael you go.
Marcus. Okay.
There you go. Now, Kev, I have to ask you about this picture.
Okay.
Is it me with the hair, or is it me that's the baby in your kid?
Of course, I'm the baby. I'm the bald baby.
But I don't carry you around that way. You're the one who carries me around.
It's just funny. I thought it was a funny shot. This bald baby.
Now
imagine if I went back in time, and that's like little macro tourist.
Yeah.
Like little mini me on your chest.
Yeah. Now I'm confused. Do we have Lena or Luke online now?
That's right. Well, let's say goodbye, and then we'll get the after hours.
Absolutely.
So everyone, if you want to listen to Patrick anymore, you can go and catch him at bigpicturetrading.com, right, Patrick? And why don't you give us
follow me on Twitter at Patrick Ceresna.
Yeah, and for me,
you can follow you
at Kevin Muir. And listen, I said it on air yesterday or last week that I was going to write a little more. I got 2 off.
Yeah.
Hopefully,
you know what? And actually, they were good. They were good.
Oh, thank you.
I read them. Even one I read after the fact.
Yeah, I know. Well, that's bullshit because you and I were talking, and I asked you, and you said you hadn't read it.
No, I haven't read it, and then I went and read it. Because you know what, I was inspired by because we were talking about it after interviewing Nancy, right?
Yeah.
And so I went and tried to understand your break-evens trade a little bit, but I still don't get it. You're
Okay.
too much smarter than me.
Anyway, so you can follow me at themacrotourist.com. A big thanks to Raoul and Nancy. It's a great show. Oh, and listen, actually, we never mentioned this, Patrick. If anyone's listening to this, we're actually taping this on Thursday. We actually kind of screwed up not telling you that.
Not screwing. Yeah, we should have said that.
We should have told everyone we're taping on Thursday. So if
when they're looking at all the charts I was showing, it's like
yeah. Anyways, only the true huddlers are at this point listening. So those are the ones that matter, and they're the ones that'll know that we taped on Thursday because you have your money show on a Friday. Anyways, thanks for this great episode, and see you next week. Okay, joining us in the after hours now is Raoul. That's it was such a great story, the Tales for the Trading. I don't know if I'm going to be able to kind of get anything better from you, but let's give it a try anyways. So Raoul, I know I saw you, and I just have to ask you one question. I saw you were getting married. I think you were talking about that on RealVision. Is that correct?
That's right. I am getting remarried, actually. So I've been married once before, but I met a girl on Little Cayman, which is an island of 140 people. So it's a bizarre place for me to meet a life partner. But we are getting married. We're getting married in the desert outside Marrakesh in Morocco in a week's time.
Oh, well, that's terrific. Congratulations. That's an awesome story.
Thank you.
Yeah.
I like a bit of a travel and adventure. So travel and adventure is kind of in my blood. So doing it in Marrakesh was an extraordinary place. Will be a lot of fun.
How did you choose Little Cayman? You mentioned that you moved from Spain and you decided you were going to buy some U.S. dollar denominated real estate. And how did you choose there?
As all good stories start, I was on a dive boat in the Galapagos. When I met, I was on a shark diving trip in the remote islands of the Galapagos when I met a bunch of people who lived in Cayman. And I had been in a search for years for tropical beach. I spent a lot of time going around the world diving with sharks and just diving in general. And I was I loved the tropics. I loved the Mediterranean and I loved the tropical turquoise sea. And I always had that dream. And so I was in a fortunate enough situation that I thought, I could probably go and do this. So I'd been searching for years. And I happened to be on that dive, but they said Cayman Islands. I'm like, no, it's not really for me. It's a bit suburban. It's a bit kind of more kind of US orientated. And then they said, well, you might like Little Cayman. And Little Cayman's entirely different. I mean, feels like a remote island, but it's an hour's flight from Miami. And there is 140 people, perfect nature, an extraordinary piece of beach. And I'm looking out the window now at the huge French doors here, and it's just, there's nothing else in sight. I've just got white sand beach, nature, turquoise sea, and in the far distance is the island of Cayman Brac. So,
so do you have your own boat that gets back and forth, or do you have to go on some sort of ferry?
It's 90 miles from the mainland, so there's.
Oh, it's that far. Oh, I didn't realize that.
So it's 4 or 5 flights a day. There's a little Twin Otter, a 1960s Twin Otter, which is like the Land Rover of the skies. Fantastic little thing, and you just pop over. It takes 30 minutes, so it's actually pretty easy.
I didn't realize that. I believe that Twin Otter, that's a Canadian plane.
Yes, I think it is.
Yeah, and I think like 90% of them that were ever built are still in operation.
Exactly. I mean, they're like Land Rovers. You just can't get rid of them. You can just fix them with a spanner and a bit of tape.
Which is kind of a little scarier when it's your plane, but okay. So Raoul, I'm going to ask you some questions here. If you were could go back in time and tell a young Raoul what he should do differently, what would you tell him?
Nothing.
No?
I literally wouldn't do anything differently, because life is a journey of making failure is part of the journey, and making mistakes is all part of it. And I think you don't become the person you are today without all the mistakes that you've made in the past. So, I wouldn't change anything. I've been really lucky and I've had highs and lows, and like everybody else. But in the end, it's been a fantastic journey and I wouldn't change anything.
Oh, that's a very Zen-like comment. I must say, good for you. So how about this? How about then what would you tell a young kid that's interested in the markets today, whether they want to be a portfolio manager or trader? Obviously it's a lot different than back then when you started. What advice do you give to young people today?
So I have a lot of people reaching out to me saying, I want to get into this. How do I think about it? How do I get into a hedge fund? And my advice is always the same as don't.
Really?
Our business has changed. It is a shrinking industry, so you're fighting structural headwinds. The largest pool of capital on earth is gradually leaving the market, which is the baby boomers. It's not going to be offset by the millennial generation. So you've got a structural change in financial markets. Go and ask anybody who ever worked in the financial markets in Tokyo about what that means, or even in Europe. It means a slow, miserable death. So that industry, I don't think, is a good industry. I think, as you talked about, it's difficult for time horizon, a number of different things, even for people to get into the hedge fund industry, which is shrinking dramatically. I always say, if you want to take risk and you want to see patterns and see the world and figure out how to do things, go and start a business. That's the real opportunity. If you want to have a bet, then think about the future of the world doesn't lie in what we know. It lies in probably digital assets and the trading and understanding of what the massive impacts that has on the future of finance, and not in the obvious ways of, the rise of Bitcoin or whatever else, cryptocurrencies. I'm not talking about that. I'm talking about the ability to trade assets will change everything. Even, for example, what we understand a corporation today to be doesn't need to exist in the future. So the reason we have corporations, the word corporate, is because it makes it like a human body, i.e. it has a human entity, which means you can sue it, that kind of thing. So using new fractional ownership and the tokenization of assets, which is where the world is going to, a company like Exxon doesn't have to be a corporation. It can be a large amalgamation of streams of income or streams of assets, of which you can choose portfolios of parts of, some of, all of, etc. So the all or nothing approach to how we look at things now will go. So even because of the ability, and we're already seeing on sports stars and other people and the music industry, I think even Bowie pretty much started this with the Bowie bonds, is people can also sell off parts of their future income streams via tokenization. And it means that anybody can own a share of the most expensive building in the world or the most expensive car. So everything becomes a digital asset with recorded ownership, and therefore we have an enormous new set of things that we can trade and invest in, because we can invest in pretty much anything. That really changes the overall landscape, and we're not there yet. But in the next 20 years, even if you hear how Mark Carney and the ECB have been talking about kind of a digital stable currency, the world is going this way. Things are changing super fast. And so, I think anything that we're looking at now, how we trade, how we think of investing, I think is going to change. So if you want to do it, be in that part of the industry. If you really want to take risk, make money, and earn the future income that is an outsized return, start a business.
So, given that attitude, does that mean that you believe that the next reserve currency most likely won't be a currency at all?
Depends what we mean by currency. Again,
not a nation's currency, but like some sort of cryptocurrency of some sort, an electronic form.
I think the most likely outcome first is some form of this stable coin. So if you think of, there are stable coins that people may have heard of, like Tether. They're not stable coins, they're basically US dollar pegs. But the stable coin that that Facebook came up with was clever. The reason being is it's because it was dollars plus the other currencies. So everything else normally is a basket of currencies versus the dollar. But this wasn't. So if you do it that way, then basically that currency, if you think of it as a basket of all currencies, including dollars, and you could throw gold and you could throw Bitcoin, whatever it is in that basket, will only go up and down with global money supply. So now you've created something that is very different. So it acts truly like a fiat currency, or even like, dare I say, Bitcoin, because money supply, stock flow becomes the most important part of the equation. So now if all governments can be part of that then there is going to be a move towards seeing how stable you can get your currency, and the argument will be you're better to go to a cryptocurrency that has a formula in terms of money supply. So then you don't have to manage your own currency. So you put it into the stable basket, all world trade goes onto stable coin, and your own currency remains stable against it. Works pretty well. So I think that is certainly part of the answer. And it won't be Libra, but it's very clear that they let the genie out of the bottle. It means that the central banks are in a fight now to launch something, I think. And that's what Mark Carney and the ECB have just told you. The dollar system they have to walk away from. So that's interesting in itself, but it also means that anybody in the private sector can set up a global currency basket of the same form, the stable coin. That in itself is an interesting thing, because then who issues currency? What is currency? There's a nation state to pay taxes currency, but there's also trading currency. Okay, we're in a different world already now. And then you've got maybe a global reserve currency, which could be Bitcoin. Now, Bitcoin, why do I say that? It's just because that as it increases in value, it's decentralized, so it has certain value within a digital system which nothing else can have. It has a collateral value because it can't be, it can't be inflated away. So it's far too early to think in these terms yet, but at some point it will stabilize massively because it reaches its actual real market cap, will be something closer to probably global money supply. And over time, therefore, you actually have a competitor to the global monetary system. So, and again, I'm just thinking big picture. None of us knows this stuff. I'm not a person pounding the table saying this is definitely going to happen, but I can see the steps to get there. The kind of knock-on effects are happening. And when I first got into Bitcoin, I saw that bit pretty early, not the moving parts, but that this was an answer to something different.
Yeah, actually, you mentioned getting into Bitcoin early. I seem to remember you said $200. I thought I remember a GMI report that was the first time I'd actually heard of you, where it was at $100. Am I wrong? I thought you...
I think it was $200, or maybe I bought it the first time at $200. Maybe I wrote about it a bit earlier. But that piece is I wrote about it, and basically... before most other people, I just thought, okay, how the hell do we value this thing? I understand what it might be. So I just said, listen, the only way I can think of this is if it's supposed to be some sort of digital gold, which was an idea at the time, and it still is one of the ideas of what this thing could be. I just said, well, we'll just impute what it looks like versus the kind of above ground supply versus known reserve underground supply of gold, and do the same to Bitcoin. And I got the valuation with gold roughly here at like $1,300, $1,400, $1,500. Bitcoin should have been worth $1 million.
Yeah. And you came out and said, listen, even if you discount that for the probability that it works, it's still, easily goes to 10,000 or something was your number. And I'll tell you a quick story about my Bitcoin experience. I had a young, smart guy beside me that was a computer engineer, and he told me about Bitcoin at $5. I listened to him explain it, and I told him that was the stupidest thing I'd ever heard, and that he should just not talk about that anymore. And he says, a couple months later, he says to me, that thing that was $5 is now $50. And I thought to myself, well, it's $50. It could be 500 or 5,000. And I couldn't bring myself to buy it, but I basically said, well, how do you make these? And I got to know it. And we ended up having our own little Bitcoin farm in our office. Really? We were buying butterfly machines, and we were mining them. And then I'm actually my kind of first job on an institutional desk, I was an institutional equity derivatives trader, but I also did a lot of computer work. We did a lot of computerized trading, so I was one of the first to write what's like an interlisted arb between the U.S. and Canadian stock exchanges. So I would research in motion would be listed in both, so I would just arb the two. So I realized that the same thing could be done in Bitcoin, so we wrote that and we made all this money. So it went from, and then I saw your piece, and you kind of, to me, you were like the first serious thinker I'd ever seen that had talked about the fact that it could go up. And so I think that first rally, it went to $1,000, and we rode it, we were arbing it, we were mining it, we did great. And then it fell to $200. And I thought to myself, okay, that's it. That was the greatest bubble of because I'm a little more of a skeptic than you are. I said, it's a great bubble. It's terrific. I mean, we made this money, and we sold all of our machines, and I never thought about it again. And I never imagined that it would kind of come back here and be here. And little did I realize that the real, big move was still ahead of us.
Yeah, I mean, I fell out of love with Bitcoin when in that 2017 rally. And I was like, look, I don't understand what this forking is, what's going on, all these different tokens and these new currencies. I'm like, this looks like, you're going to compete it away to zero and there's too much competition and nobody's going to know what. And people like Mark Hart said, you're wrong. They said that there will only be one real competitor out of this and there'll be a few smaller ones. But, there's not one competitor. There's only going to be one and Bitcoin will beat them all. I'm like, I don't really believe that. And then after the inevitable bubble and then the sell-off, I started to realize that all the others had basically gone to zero. There's a few of the others like Ethereum that have some proven value. And then Bitcoin was like still at $200 billion market cap. And it was then at that point, there was a guy called Dan Tapiero, who's another kind of macro friend of mine who worked for everybody from Tiger to Steinhardt to Stan Druckenmiller. He's bugging me every other day saying, and there's a lot going on in currency markets and fixed income markets. So I'm like, he keeps bugging me saying, Raoul, look at Bitcoin. I'm like, Dan, I'm no interest. There's too much going on. And he keeps tapping me on the shoulder every 2 days. And eventually I sat down and talked to him on RealVision. And I realized he basically changed my mind to realize, okay, this is so much bigger than I ever thought about. I didn't quite understand how big this was. And, just it's just, if you just think of it as an option on a new system, then that's the easiest way to think of it, because it's almost impossible to understand where it's actually going and what it is, because it's a lot of things.
Right. Okay, so we're going to get one last question. You've been very generous with your time, and we're going to ask one last question. I want to kind of talk about you mentioned Twitter and how you are very giving on Twitter. You talk a lot and you answer many people's questions. And I must say that I have you've treated me like the greatest gentleman. Like when I was a little bit of a bond bear, and in that rally when everyone was doing kind of victory laps, you were very quick to kind of come to my defense and say, listen, everyone trades differently, and you have to remember that the market has a way of making fools of all of us. And I do appreciate it. It was very kind of you. But one of the things that I see is that not everyone's as kind to you. And I've noticed that over the years, some people have taken to kind of showing the bad trades and kind of bringing them to everybody's light. And we all have bad trades. And I just want to kind of get your kind of feeling about why Twitter seems to bring out the worst in many people. And I've noticed this as well.
Yeah.
It's both a terrific, unbelievable place and an awful place at the same time.
Yes. And I find some of that stuff, you can ignore. I find that Twitter is really led by the kind of community leaders. So if we're all good to each other, then people learn. And they start policing themselves, and that's an amazing thing that happens now. Mainly, there's a lot on FinTwit. There are some people who have a huge following, are just snarky and undermining of everybody and everything. And there's a few of them, and I won't mention their names, but they make my Twitter experience extremely unpleasant because of what they're like, and they're kind of like schoolyard bullies, and they're the schoolyard bullies of Twitter, where they're always kind of thinking they're smarter than everybody, sneering at people. And, as you and I know, if you've actually got skin in the game, you have humility, because we are not right most of the time. We try to be right as much as we can. And you have to understand that this game is about, we're all trying to figure this out. Nobody's trying to ram anything down each other's throats. It's not a competition of me versus you. It's you and I trying to think aloud on Twitter and share our views. And we'll, sometimes we get it right, sometimes we get it wrong, and we have different time horizons. So somebody will have said, see, I was right, made a fortune in the bond market by shorting it in the last 2 weeks. Yes, you have. I am still up a lot in the bond market, and I've given back some in the last 2 weeks. It's all part of the same thing. So that's what I don't like community leaders who are snarky and kind of subtweet people and do all of that stuff. I think they're just dicks and they ruin the entire environment.
Yeah. And the other thing I'm actually shocked about, I don't know if it's a function of us growing up on a trading desk, but why do people think that I want to convince everyone of my views? If everyone felt the way I did, I would have nobody to trade with. I welcome other people's views because I need somebody to be on the other side of my trades.
That's right. And exactly right. I mean, our job is not to persuade everybody, but people think it is. And so therefore they're like, well, you're never going to persuade me. I'm like, I don't care whether I persuade you, but I'd love to have a chat with why you think I might be different, why the outcomes might be different than I think. That's great.
Yeah, I 100% agree. But I have a line that I say, meet you in the machine, because when we used to have a disagreement on the trading desk, we'd both go into the machine and we'd have a trade. And it was something that it was great when we disagreed because it meant we had a trade.
That's right. And, you know, there was the one that really upset me the most is, and it's because many people on Twitter only see things through their perspectives. So recently, I think it was Joe Wiesenthal, who tends to be one of the Twitter bullies, is trying to call me out about the end game, the 2012 presentation that I gave to the Morgan Stanley hedge fund conference in Shanghai, where I talked about the risk of Europe completely imploding. Now, 2012, if you remember, that was the Eurozone crisis. And I was joining the dots saying, if this happens, then we're going here. So that wasn't leaked to anybody. I didn't leak it. Somebody got the presentation, gave it to the press. It went around, became the largest read financial article in internet history at the time. And that was nothing to do with me. It had a life of its own. So I wasn't trying to use it to gather attention. But anyway, by the end of it, as we know, the markets collapsed over that period, but eventually Draghi saved the day, and we got away with what most people would say, well, it was all okay. Why were you predicting doom? And this is the problem with something like that, is people have a very short memory. At that time, I was living in Spain. Youth unemployment hit 50%. Friends of mine, like a third of my friends living in a beach town in Spain, went bankrupt. It was an extraordinary time. The ECB forced Spain to take $10 billion to prop up their banking system because we were going to lose all the banks. Friends of mine were getting bailed in by the banking sector, essentially, because they'd turned deposit accounts into preference shares and then basically written them off to zero. So people were losing their deposits. People didn't know where to go. I had to get cash in the house and get a generator because I thought we were going to lose electricity. Meanwhile, Cyprus entirely shut down. I mean, everybody's life savings, anybody had over 100 grand, including every business, lost all of their money as the ECB bailed in the banking system. So all of that went on. There were rioting in the streets all across Europe, and then people call you out on Twitter and go, "See, the world didn't end." I'm like, "Are you fucking kidding me?" It's the lack of context people have that it is extraordinary.
Yeah, and it to me, it's also that both sides are bad. The bulls that are feeling smug that everything's great, and the bears that are convinced that the world is going to end all the time. And I just try to be a little more pragmatic about the whole thing. And I agree with you. I'm always like, I welcome people telling me information about why I might be wrong. I love to hear the other side of it. But if you're just going to attack me and tell me what an idiot I am, like, I just very quickly find that like it just becomes so boring and so it ruins Twitter for me. And it's unfortunate.
I find the same. I mean, the other group I don't like on Twitter, actually the crypto crowd has got better. They were really bad for a while. But the one that's very smug is the social justice warrior Twitter that's generally bleeded out of gold Twitter and has, gone to Tesla and every stock's a fraud. And, it's, there are some really extraordinary, amazing short sellers who are on Twitter. And then there's a bunch of these tourists who have gone onto this. They've become social justice warriors, and they're just bullies. Yeah. So, some poor guy.
I don't know how.
Go on.
Sorry, go ahead.
Yeah. I mean, I don't know what they get out of, bullying some person who's got a different view on Tesla than them. Yeah, they may be wrong. Tesla may be going to zero. It may not be, but they're hunting in packs at people. And I just think and the Tesla people are equally as bad. The bulls are equally as bad. And it's just like, really, guys, this is just playground stuff.
I think that anybody who's sure about anything like that, like with that sort of certainty, you have to ignore, because I'm the first one to tell you, I don't know. I can give you my odds of it. And my whole job is to try to figure out points where the market is underestimating or overestimating the odds of something happening. And that's all I care about is the market correct about assigning the probabilities correctly. And I'm just looking for differences. And so I don't understand why you have to believe I'm always bullish, I'm always bearish. No, I'm just looking for opportunities. And I find these people where it's a religion, whether it be bull's religion, bear religion, or whatever, it just ends up making Twitter a smaller place instead of a bigger place.
That's right. And it creates tribalism as well. And I don't like the tribalism element. I mean, I much like people who change their minds, who shift. Now, there's whole periods of time where, because where the business cycle is, people are going to be one way round. But people don't bother exploring that view. They just think that that's what they always are. So it's a weird world. I find Twitter one of the most amazing resources I've ever had. I almost don't use any other source of news any longer. And I don't read anybody else's research. Never really have, but Twitter makes it amazing because I get a bunch of people I trust that I've curated, and I can get their opinion. So if I want to know what you're thinking, Kevin, I can just go to your Twitter feed. I can see that you'll chip into a discussion we're having, and whether you've got the same view as me, a different view, or you come up with something I didn't even think about, wasn't even looking at. And that's so powerful.
Oh, I agree. It's like a trading desk. I always tell kids, like, I'm a little more bullish about the industry going forward. I'm hopeful that that this move from computerized trading, or from regular traders down to computerized trading, is almost fully complete, and that maybe going forward the industry will adapt and go forward. And I always tell kids that are interested in the industry, I said, first thing you need to do is get on Twitter, because there are an amazing amount of people there, really smart people that I didn't have access to, that now all of a sudden I can see what they think. Like, you're on there. I love the Haynes and what's that? Hayek and Keynes there. He's awesome. Like, and these guys they're people that have backgrounds that previously were just unheard of, that they would share it. Like, you were lucky enough to talk to all those, great hedge fund greats throughout the years. But now all of a sudden, and your RealVision is another example.
Yeah.
I think you used the word democratizing, like, finance.
Right.
I agree. And
Twitter does that, right? I can get access. Yeah. We would have never have met if it wasn't for Twitter. So,
for sure.
I would have never have met most of the people I now know in the finance world if it wasn't for Twitter. Which is unbelievable. And RealVision is just the part of that same process, but I get to hear what's on your mind for half an hour or an hour. Well, I'm never going to get that chance unless I manage to get in front of you at some point, sit down and have a talk. But this is incredibly powerful, where we get to hear for everybody's minds what they think is going on, and where the opportunity lies or where the risk lies. It's amazing.
Yeah. No, it is terrific. Anyways, I just want to thank you for RealVision, because it's for me, it's been part of my learning experience, and I enjoy it all the time. And I'll just I'll say one last time, if you haven't gone and checked it out, do you offer a free trial? I can't remember. Is that correct?
Yeah, it's a free trial. There's a free trial, and there's also a free version of it. It has a lot less content, but just go to the website and just knock your socks off, go and look at the content, and you'll end up subscribing, because I think it's like 63% of everybody even takes a free trial ends up subscribing because they love it.
Yeah, you can. I've been a subscriber for a long time, and I'm a big fan. And I just want to thank you very much. It was a pleasure having you on, and I want to wish you all the best in your wedding next week.
Thank you very much. I really enjoyed the podcast as well. Really enjoyed the chat. It was good fun.
Thanks again. Take care.
Cheers.
Okay, Lena, hop on.
Lena or Luke? Which one is it?
No, that's Lena. She's back.
Is it a he or is it a she?
I know.
Is it a they?
So Lena, Luke jumped on there, and we were shocked. It's like, that's not Lena.
Yeah, he couldn't resist.
He's disregarded my instructions.
He was supposed to say silent during the recording, wasn't he?
That's right.
That's right.
Couldn't resist.
That's
okay.
funny.
So let's talk about our beer.
Yeah.
Oh yeah, I actually really liked it. I'm through my second one already.
Yeah. So I'm a big fan.
There's a second one.
Mm-hmm.
Yeah. So I'm a big fan. I'm gonna give it the first.
So we had just to be clear, we had 3 beers from Wisconsin.
Yeah, that's a true sponsor. That's a good sponsor. Sending us their whole portfolio of beers. That's what we want.
Yeah, we
Except
want
for
a
the
whole
sours.
portfolio. And exactly, no more sours. No, just kidding. I want the sours. But the thing is that so this is the last one of the series. We had Fantasy Factory, and the other one was a Spotted Cow. And so this last red ale that we're having here is the last of that, and then we're gonna hit that New York series, right? We're gonna do a couple of those.
So I'm a big fan. This red ale, I'm gonna give it an 8.5. Solid beer. That is a good beer to drink. I really like it. It's probably my favorite of these Wisconsin beers.
Really?
Yep. I like
That's a pretty high rating.
Yeah, no, I like it. I'm a big fan. I don't know why. How about you guys?
Oh, Lena?
It's drinkable for me, but I don't know if I really liked it that much. But I mean, I'm done with the bottle, so I liked it enough. I would give it an 8.4.
8.4. That's a pretty good score for giving. You talked it down and then you.
I don't know.
Maybe
if we rated the beers in the beginning of the show, maybe it would have a little bit different. Now that I'm
completely done, and you're just going back on the aftertaste that's left in your mouth, right?
That's right.
Well, let me just take one more sip here. You know what? I'm going to let you take the top score. I'm going to say like an 8.2 or something like that. I enjoy it, though. I think that's a very high score.
It's not a competition.
No. But I consider anything above 8 to be a premium good beer. There's no reason why I would never not buy this. This is good. It's a delicious beer, and I'm gonna let you kind of walk away with the big high score, but it's definitely a nice beer. Thanks to Central Waters for sponsoring us on that.
Yeah.
It's prepping me for tomorrow.
There you go. Yeah, absolutely. So we're recording this before the Market Huddle meetup, but everyone listening will have listened to it after the Market Huddle, the Market Huddle meetup has actually occurred, and so it's going to be a good time.
No reason to plug it. No reason to plug it, Patrick.
We're not plugging it, but what we're doing is we're talking about the fact that we're going to have a good time with so many of our listeners. I'm looking forward to it.
Are we going to be playing any games at the rec?
No. Well, I mean,
Why not?
Well, you can if you want to, but I'm there for the beers.
So, Lena, are you going to be able to go? Like, is your macro voices going to be all done and stuff? Are you going to be able to be there?
Yeah, of course.
Okay. Is the huddle going to be like out Sunday morning? Because like you were like.
I don't know. It might be a little bit later on Saturday, but depending on how many beers I have at the rec room, I guess.
Okay.
If it's like a Christmas dinner drinks, then yeah, for sure it'll be.
So and Kev, you were on Macro Voices today. That was good. I mean, you did a great job talking repo, and so yeah, that's everyone listening to both podcasts has got plenty of listening to you.
Yeah, which I feel sorry for them. Like, I'm not much of a repo expert. I don't even play one on TV. You guys, that's what happens when someone big, cancels on you guys. You call up the Kevin Meister.
Yeah, you're Plan B.
Plan B.
You mean the pill?
Yeah.
I'm surprised you guys know what that is.
I know.
No comment. No comment.
Oh God, I'm gonna get in trouble on 2 things now this week. It's just it's Canada's time to get in trouble with Trudeau doing all sorts of terrible things.
So I'm not even going to say anything because I have some opinions and I'm not going to say it on air.
Yeah.
I'm surprised you guys didn't include that picture in one of your slides.
Oh, we wouldn't do that. That's terrible what he's done.
Stop it. All right, let's move on.
The only thing worse is like his energy policy, which is like what I'm really upset about. But anyways, let's not go there. Okay, well,
anyway, that was good. That was good. You know what? I'm looking forward to this weekend. It's going to be great, and it was a great episode. I think we had a lot of fun. And yeah.
So hopefully, Patrick, we'll get a couple of sponsors, and we'll get some more beers, right?
Yes.
We should be working on that.
Yes, if anybody listening to the show, if you're listening this far into the show, and you have any connections to a brewery that wants to sponsor us by sending us a product,
or if you want to self-sponsor, that's fine as well.
Yeah. Oh, yeah. If you're a listener and you
all beers accepted.
Yeah. So we have a little bit of a problem because we've run out of product.
Well. We have run out of product 4 weeks out. We still have pretty good for the next few weeks. Yeah. We have some New York sponsors and that are coming up. And I actually have a buddy that owns a brewery that hasn't sponsored us yet, but he's going to send us a few. So
what a good buddy.
That's an Ontario brewery, so it's more local here. Well,
people that are listening to it this far are probably just as drunk as you guys.
Probably more.
Yeah, probably. Sunday morning, they're so drunk, I'm sure.
Except that my buddy that I got on Twitter that told me that he listened to me as while he was running 50K. 50.
Wow.
50K?
I know.
Can you run that in one day?
Oh, yeah. People do that. People like...
Oh, the Ironman thing is two marathons, right? Like it's like that 84K or whatever it is.
I'm lucky if I walk like 7K in one day.
So this guy, he's pretty desperate. When you're 50K, you need a lot of listening material. That's what this guy's listening to. Anyways, thanks for listening.
Wow.
Yeah.
Hope you're still listening.
Thank you for listening.
Okay. Have a
all
good
right.
weekend,
Anyway, it was great. See you guys, and we'll reconvene next week.
Okay, take care.
All right. Cheers.